Hey, welcome everyone to another episode this Wednesday of Real Talk with Joe and Cody. My name is Joe Skipper. I'm the owner of Skipper Realty Group, brokered by eXp Realty here in Oregon. I am with my good friend Cody Wilhelm with Residential Mortgage. Hello, Cody.
How you doing, Joe?
Good, man. Good. I'm feeling a little under the weather. And yeah, but other than that, I got to push through, man. All the fans of Real Talk need us every
They
Wednesday. So
do.
I gotta I
I
gotta
can't do it by
gotta push
myself.
through. All of them are just flocking in to watch
Yes.
this. But
Yes.
no, I got some good feedback the other about recasting last week. Quite a few people
Oh,
reached
good.
out and just didn't even know what that was like and what is available to them. So I think it was a
Nice.
cool thing for us to go over. So happy we went
Yeah.
over that and kind of hopefully give some insight to people that could use it in the future. But
Well, it's one of those
on
topics too that, I know we talked about it before, but it's like it's not a common thing. So
no,
you wouldn't really expect a lot of people to know about it unless you're maybe in the business. So
yeah,
it's
which is
good.
weird because it is actually kind of a cool thing, and it like is something that I think a lot of people could use, and
Yeah.
so I don't know, just interesting. You lenders all keep your secrets until it's actually needed, so
Yeah. We're like, all right,
uh,
well, I'm
yeah,
gonna
I'm not
wait
gonna give
six
them that.
years and then finally have any opportunity to talk about
Boom, here you
recasting.
go.
Been waiting for this.
Uh, well, on that note, before we get started, I just want to see anything new on the lending side of things, and anything you want to share with the group. What's going on with that?
Nothing too crazy. I know the Fed met this morning. I haven't had a chance. I've kind of been on the phone a lot this morning, so I haven't had a chance to really dive into what all was talked about with it. But I know they did meet, so I can give a better update next week. But as far as the interest rates go, we're kind of still really leveled out this week and last week. It's been one day's a little better, the next day's a little worse. So it's overall we're still about flat with where things are at.
Yeah, yeah. On the real estate side, it's kind of like everyone's kind of interested to get in the market and wants to get in, but everyone's kind of hedging their bets too. They're like, okay, I heard it's going to go lower, so maybe I wait a few months, or maybe I do
Yeah.
this. It's always that like judging the market and predicting what's going to go on, which you never can do. But
Nope.
whatever,
Nope.
that's on the real estate side of things.
Yeah.
Nothing real new to report on that end. But homes are sitting on the
Okay.
market a little bit longer.
Yeah.
But we talked about that last week. I think that's more of an indicative of a normal stabilization versus anything crazy. I
Yeah.
think market's just kind of starting to stabilize. Buyers are taking their time, making sure they're getting in the right spot. But
Hmm.
hey, we had talked offline about this, and I think it's a really fascinating topic, and that's why I wanted to talk about it today. Is a DSCR loan, and I came about it just from watching, like, we always follow like our nerd stuff of our lenders and different people in the
Yeah.
industry on TikTok. And this guy explained what a DSCR loan is in a brief 60-second thing. But when
Uh-huh.
you brought it up, just the other day, I was like, man, I think I want to really go over that. I know a very little about it, so I think we're all going to jump in with you on this
Yeah.
as newbies. So I think like a DSCR loan, if you could kind of just even explain what it is, and then I'll just ask you questions as we go, because I think this, correct me if I'm wrong, but I think this is an opportunity for people that either self-employed or various other factors that might factor into their history than that traditional buyer may see this opportunity, and maybe some of the downsides to this type of loan. But anyways,
Hmm.
I'm going to let you talk. I want you to explain what a DSCR loan is and how we can get into it.
Yes. So a DSCR loan, it's actually an acronym. It's for debt service coverage ratio. And you tell anybody that and they're going to be like, what the heck does that even mean? Um, so the way that the loan works is it is based on the cash flow of the investment property. So you can't do it on a primary residence. It has to be an investment property. I'll go through the different property types and everything, but in a quick little nutshell, it is based on the cash flow of the property. So the way that you would figure out like what you're eligible for, and different lenders have different parameters. The lender that we go through it with, has a minimum of 0.75 DSCR. So the way that you would figure that out is you take your rent that you can get from the property and you divide that by the proposed mortgage. And when you get a number of 0.75 or greater, then you are eligible. Credit score, like our credit score minimum is 660, but it's not based on any of your income. So like most traditional loans, it is income based, right? We have to get
Yeah.
your taxes, your W-2s, pay stubs, all that stuff, and figure out what your debt to income is. Well, this is all just strictly based on the property. So, like you were saying, for investors, people that it seems to be the most effective for are people that are self-employed, and they might write off a lot from their business, and the bottom line doesn't show what they actually make. It shows what their taxable income is. This takes that out of the equation. They can work on that. A couple cool features with it are there is no amount of finance properties that you can have. Whereas if you do a traditional investment property loan through, say, Fannie Mae or Freddie Mac, they have a cap of 10 finance properties. Once you finance 10 or more properties at one time, then they will no longer lend to you. So if you're somebody that is, already has 10 finance properties, including their primary residence, a DSCR loan would be great if you're still looking to invest, because you can do as many DSCR loans as you want because there is no limit on them. So it kind of opens
Hmm.
up the door. If you are, if if your income is good and you can qualify using a traditional loan, you're going to get a better interest rate. So you're probably better off just doing a conventional through Fannie Mae, Freddie Mac, which is, for anybody that's watching, if anybody is watching, there is really, those are the two main investors when it comes to conventional loans.
So what? That's what I figured. That was one of the questions I had. It has to be a higher interest rate. It has to be
Hmm.
something. Like, what's the downside,
Yeah.
to that? One is the interest rate. So can you just say? I know these are all generic numbers, but
Yeah.
how much more in interest are you going to pay on one of those sort of loans versus a conventional if you can do it?
Yeah, it's going to be at least a couple percent higher.
Okay.
And that's going to be based on a couple different factors. One is, what is the DSCR, the coverage ratio, the debt service coverage ratio? Because the higher that number goes, meaning your cash flow is higher,
Hmm.
it's going to get you a better rate. There's different factors with reserves. So the better the overall profile is, the better your interest rate. But again, you're going to be paying more than likely at least a couple percentage points higher, because if you think about it, it is for the lender, it's a much riskier
Yeah.
loan because you're really not basing it on anything other than just strictly the property, which sometimes I think actually makes sense. But, I know it's not nearly as safe as what it would be if they were to look at it and say, you yourself can actually qualify to take this on, as opposed to just strictly the property. So, yeah,
So
just like
how?
with anything, like if you don't meet the original criteria of what the standard, I guess you could say, is, there's always other options. It's just you're going to pay for it. You're going to have a higher down payment. You're going to have more in reserves that are needed. Your interest rate might be higher. So there's always some different compensating factors.
Yeah, and that's like why the couple questions like this isn't even planned, but you read my mind on what I wanted to ask is
Nice.
how so it's a higher interest rate. Do you have to have a certain amount down for it?
15% is the minimum down.
Okay.
Yep.
And then also what if if you can qualify for a traditional mortgage, can you still use the DSCR loan? Like some
Yeah.
and you could go over that, but some you if you qualify for one, you can't use the other. Is a
Right.
DSCR loan able to be used even though you could do a 20% down on or whatever you wanted to do?
Yep. Yep, you can still do it. There's no restriction. At least, and again, I'm speaking through the lender, the investor that we use. So,
Yeah.
if somebody talks to another lender, they might have different criteria on stuff, but with ours, there is not a it's not like, well, you could qualify for this, so we have to put you in this.
Okay.
If you're wanting to do a DSCR loan, one thing that's kind of unique about it too, is you can be a first time investor using this. So you don't have to be a experienced, you have a big portfolio of programs. You don't even have to own a current home. So it's really for just about anybody and everybody. So if
So,
this is what you're looking for.
yeah, I guess like how would you prove like how do you prove the income potential or the income that it's going to gain? Do you just do a stated income or do you actually have to show that hey, this property I'm going to buy is making X amount or how does that work when you have to prove the income?
Great question. There's two different factors that come into play. So one is, if there's no current tenant in the property, and you don't have a lease, you don't have anything set up, you're just going on, I think we can rent it for this much. We have to, when the appraisal is done on the property, there is a form that the appraiser will do, knowing that it's an investment property, that will give the market rents, which is essentially them coming up with what is this home average going to rent for in this neighborhood. And that's what we have to go off of for something like that. If you do have a lease agreement, say there's an existing tenant in there, we can use that as long as we can verify the last 3 months deposits showing that that's what it was. And we pair that with the lease agreement. So as long
Okay.
as we have verified proof of what this is actually renting for, then we can go off of that. But if there is no proof, if we can't get that documentation for some reason, then it's going to be the lower of the two. So lower of the lease agreement number or lower of the appraisal market rents for that. And that's what will ultimately determine what that income from that property would be.
That makes sense.
Mhm.
Now, do these like are these like do they close quickly? Are they longer term closings, or are this just a traditional wham
Yep.
bam?
Traditional wham bam. I mean, if anything, it's a little sooner just because there's not nearly the documentation, the review of everything that we have to get. So it's a simple process in the sense of the documentation is different, but less than what we would normally collect. With like I said, with we'd have to get the lease agreement. We might have to get proof of deposits, things like that. So there's other paperwork that we wouldn't normally get, but
Mhm.
it's less than what we would normally get. And while I'm on that note too, it can be used for short-term rentals, meaning like
Oh,
if
okay.
if you want to buy an Airbnb or a Verbo or whatever you want to categorize it as, we can do the same thing, and the same verification process is what's used, where you're going to have to get proof of what that is, along with the appraiser documenting what that would look like. So I know those have
Okay.
become more and more popular over time. So good
So is
option to
this
have.
yeah, it almost sounds too good to be true. So I'm gonna go over this in the end with you of like what
Yes.
the downsides are, but is it refinanceable? Like say you have a rate that's 2 percentage points higher than a traditional rates drop. Can you refinance it and get it to a lower rate, or how does that work?
Yes, you can. And they will, so you can actually refinance in this with this program as well too. So you can refinance out of it, and if you have it or you have an investment property that you want to refinance using this type of loan, that can be done as well, whether it's just a rate and term or cash out. So you have all the same options as what you would have with any other type of loan. You're not just stuck in it forever.
Okay. So
Mhm.
who do you see use this? Like, the obvious answer is investors, right? Is it
Yeah.
is it pretty heavy? Do investors use this quite a bit? Because maybe
Mhm.
it's kind of saying my lack of knowledge or stating my lack of knowledge, but I didn't know much about it until fairly recently.
Yeah, it's definitely more of an investor or somebody, like I said, that doesn't have the ability to show that their income is what it would need to be based on the normal calculation for getting a traditional loan. So you might have somebody that actually makes good money and they have money and they're set and ready to go, but their taxes just don't, they write off too much, and so they're just not eligible. So for somebody in that boat, it's perfect. And then investors, again, uh, one of the big ones is just if you're a big investor and you have more than 10 properties, or you want to have more than 10 properties, you're capped at some point, and then at that point you have
Okay.
to find other resources for what that lending is going to be. So this is a great option for that kind of more hardcore real estate investor, and or somebody that just doesn't have the proof of income that's needed to get a traditional loan.
So is there a max amount that's able to be borrowed, or is that again the same? Like, I know
It's
there's a max based on, your rental and all that sort of stuff, but is there
Yeah,
a limit there, like, we're not giving you more than X amount no matter what? Like, rent just for
yeah,
the
yeah.
city.
2 million. 2 million
Okay,
is the max on per property, and 100,000 is the minimum.
okay,
So, and again, that's just with what we have to offer. So other lenders might have different parameters, but I know for ours, it's 2 million max loan amount. So you could purchase a $3 million home using it and put down 1 million, because I know that's probably something that you're considering. It's
Yeah,
in your
yeah,
price
yeah.
range there.
I have it burning a hole in my pocket, so I was like wondering how to get it into an investment
How do I
property.
get rid
So
of this million
throwing $1 million
dollars? Like,
into that is perfect. So
yeah,
this is opened my eyes today. Thank you.
yes,
Uh,
absolutely. Yeah, and I
well,
don't know
on
if I
that note,
mentioned it before, but 660 credit score
okay.
is the minimum as well.
So I guess like, this will probably tap into both questions that I have and maybe other people have that are thinking about this is why doesn't everyone use it? Like for an investment standpoint. And
Yeah,
then what would be maybe piggybacking on that is that question of like, what's the downsides? If there are like, and maybe they're not downsides per se, but what are the things that people
yeah,
need to
you
be
could,
aware of that's different than a conventional mortgage. So
sure.
first off, why doesn't everyone use it for investing
Yeah, I
purposes?
think that why everyone doesn't use it is because it's not really talked about a whole lot, and I think most common practice is to try to get a traditional conventional loan because you're gonna get a better interest rate, which
Yeah.
especially when it comes to an investment property, you wanna have the lowest payment possible,
Yeah.
and
Yeah.
if your payment can be lower by going this route, then that's probably the route you're gonna go. So, it's gonna be for someone that either can't do it the other way or just they have the cash flow, they have everything that they need. So it really doesn't matter. They're still making money on it. They just need
Yeah.
to acquire properties because they see more value in the acquiring of properties than making an extra $100 a month by, you know, another mean possible. So
Yeah.
I wouldn't necessarily, I guess the downside to it would just be that it's not priced the same. There is just a higher interest rate that's associated with it. Um, and for some people, they just might not feel comfortable with it. Like, I want a loan that is backed by Fannie
Yeah.
Mae,
That you
backed by the
can, yeah,
government, like
for
in
sure.
case something does happen. Because we did run into that back in 07, 08 when everything
Yeah.
crashed. There were a lot of private mortgages, and if they weren't through Fannie Mae or Freddie Mac or FHA, the government put out the HARP program, which allowed you to be able to refinance
Yeah.
if you were underwater on your property. But if you had a private note, then you were just sitting there stuck with your,
Yeah.
higher interest rate and there was nothing that you could do. So for some people, it might just be the security of knowing that it is done through Fannie Mae, Freddie Mac. That might just be a feel good, like worst case scenario.
Yeah.
They're feeling good about it, but
For sure.
otherwise, I
And
think it's great.
I guess like, can you buy that down? Like, can you buy the rate down or is it only a certain point that you can,
They don't
like if
typically
you
do
are
much
heavy
for
on the
buy
cash,
downs.
okay, they don't do much.
Yeah,
Okay.
yeah,
Okay.
and there are
So it's
some
kind of what you're
property
getting.
Yeah, some property restrictions too. You can use it on most of your kind of common homes, right? It's going to be the unique properties that they won't allow. So, like your single family home, condo, townhome, you can do 1 to 4 unit properties. All
Okay. I
those are
was
going to
gonna
be
ask you that.
eligible.
Yeah.
Yeah, all those are going to be eligible. It's once you get into the log cabin, the condo they don't do manufactured homes as well. At
Okay.
least our option doesn't. Log homes, modular homes. Like once it starts to get outside of the realm of like normal, common,
Yeah.
everyday homes, it's going to be something you want to double check with your lender about. And the other thing, while I'm on the ineligible properties, is rural stuff. They're not really super interested in that. They do have a 2 acre maximum, and
Okay.
they don't want to do stuff that's like out in the boonies because you really want to. Since everything is based strictly on the rent, um, the possibility of somebody renting where it's closer in town probably a lot more likely than somebody that's out on 15 acres and
For
that
sure.
might just be a little bit harder to get somebody renting. So
For sure. Yeah, that's fascinating, man. Thank you for that. I think that,
yeah.
yeah, I think even in the real estate world where you're running your own shop and you're trying to write off as much as you can for tax purposes, but that doesn't help you
Hmm.
for buying a home, like all the sorts of stuff that you're messing with when you run your own
Yeah.
business. This could be like a really good option for people to see that and see what else is out there, just to see it, say if it works or not. But
Yeah.
when I heard it, I'm glad that you brought it up last week when we were chatting, just because I think it's a good opportunity for people. Hopefully they hear this and see if they want to dive in more and want to find out more about it. It's a good option that could be good for them. So
Yeah, yeah, and I think that it doesn't get talked about a lot, primarily just because it's kind of more of a niche product,
yeah,
the assumption is that well, there's probably only going to be a handful of people that will be interested in it, but so it doesn't get talked about nearly as much. But I do think
yeah,
it's good to kind of explore those different opportunities and things out there because you just never know who's in what situation. And
For
you and
sure.
I both see it all the time where there is no normal situation. Everybody
Yeah.
has
Yeah.
very unique things, whether it's finances or family
Yep.
situations or whatever it might be. So,
Yeah, it's not one size fits all with anything that we
no.
do and in most of life, but definitely in the mortgage realm and in the buying and selling side of things. So yeah, this is a good
Yeah.
option. So hopefully people got some value out of this. Thank you, Cody.
Yep. Absolutely.
We are in the midst, on the side note, before we leave, we're in the midst of venture with Joe and Cody, our podcast. We've done some interviews. We're going to do some more interviews this week. So we're kind of building up content for you guys. If you think that you want to be on the podcast, if you're not sure if you want to be on the podcast, but want to chat with Cody and I about kind of what that means for you, or you have a business that you kind of want to highlight, or you're a community member that you want to highlight what you do in the community, whether it's volunteer work, whatever it might be, Cody and I would love to chat with you. So if you do have any ideas or have people that you, whether that's you or whether people that you want to refer to us, please don't hesitate to reach out to Cody or I, and we'll get you on the
Hmm.
podcast. But yeah, that should be hopefully dropping pretty soon. But yeah, we've got got a few more coming in for interviews, and yeah, I'm looking forward to it, man.
Heck yeah. Yeah. It's good. A little side note. So you said
Yeah.
you're kind of getting sick. Um, my wife made a honey and garlic concoction that
Oh,
she
really?
swears by. So
Like, what's it for?
I've taken it one time.
Everything?
It's supposed to be like an immune booster.
Oh,
Um,
nice.
she takes it all the time, and I've taken it one time, and I'm kind of like a little kid when it comes to anything medicine related. Where I'm like, no, I don't want it. It's yeah, it's icky. But
Yeah,
she swears
yeah.
by it, and I will say, as much as I hope she's not listening to this, um, me and the kids have been way more sick than she has, so there might be something to it.
Oh, really? I might have to
Yeah,
try it. I like honey and I like garlic, so that could
yeah,
work. So,
right.
well, we'll see. I hope it's just kind of a fleeting thing, but yeah, it's
Yeah,
not been fun. But when you have kids in school districts, they're going to bring back everything that is in the schools. So that's, I think, what
yes,
I'm getting. So, but
the gift that
anyways,
keeps
man,
giving.
well, yes, for sure. Well, thank you so much. Thanks for that information. And
Yeah,
if you guys
thank
have any
you.
questions about that or venture with Cody and I, let me know. And until next week, man, we'll talk with you soon.
Yeah, we'll see you next week.